the next thing you got to do is determine what your strategy is going to do or is going to be. So, as I showed you, you have three defined strategies for selling covered calls. You can sell in the money, at the money, or out of the money, right? For me, I always sell at the money. Okay. The reason I do this is because the at the money, out of the money strategy, there is zero risk involved. You never risk anything. If you buy your shares at 689.23 and sell at 690 or higher, you can never lose money. If you're assigned, you're always going to be assigned at a price over what you paid or at what you paid. So you can't lose any money. So I always do the at the monies because they give me the most guaranteed premium. Okay. I like to know what my consistent monthly income is going to be. And I don't want you to confuse that with a specific dollar amount. So, for example, on average, I get about $3.50 for every covered call I sell. And I'm usually doing 7-day covered calls. So, as you can see, there's not a 7-day covered call showing on the option chain right now. And that's because it's a Saturday, right? And actually, do we have a holiday coming up? I don't know if we have a holiday coming up, and that's why. But in either case, um, if I can't do the 7, I do the 6, right? So just looking at a 6-day covered call, and at the money 6-day covered call is showing $5.74. That's extremely high. It's not typically there, but it's high because the market's closed right now. And so the market closed at 689.23. But if you look at after hours trading, is showing it at 687, 688, the bid ask spread. So the numbers for the options are a little off. Okay. So generally an at the money cover call for me is somewhere in the $3 to $4 range. Okay. And so when I do that, I'm guaranteeing I make $4. Okay. So that's how I trade it. However, I told you about out of the money cover calls, and this is for, I have quite a few students that don't like getting assigned and seeing the loss in capital gains. And what do I mean by that? They buy the shares at 689.23 and they sell a 690 covered call. And then at expiration, 6 days later on the 30th of January, the market's at 695. And they look at that and say, I just lost $5 in capital gains per share. And if I own 100 shares, that's $500. And they don't like that. And so what they do is they say, okay, well, let me try and find a kind of happy medium there. And so some folks do a calculation. They say, well, I think the market's going to move up X amount of percent. And they do that calculation and they sell that strike. Others, which is a much easier system, they say, well, I want to at least generate $2 in premium. So then they'll look for an option, a call option that is going to generate $2 in premium. And then that's their strike price. So in this case, looking at the option chain, these options are a little off, but if you look at the option chain right now, the strike price that's going to generate $2 in premium is the 695. So that's the one they would sell. Now, here's the caveat to that. They are going to make potentially much more money than I will selling the at the money. However, my income is guaranteed when I sell the at the money. If the market doesn't move anywhere and on expiration day it's below my strike price, uh, there's no harm, no foul. Whereas if you sell the out of the money for that 695, yes, you have the potential of generating another $5 in return in premium. But if the market's at 694 at expiration, you don't get assigned. And so you only guaranteed $2.16. So that's really the difference there. Okay. When you sell an out of the money, you're guaranteeing the initial premium with the potential of more, but that's always going to be less than the guaranteed at the money option. Okay. When I sell an at the money, I get $5 or $4 and I don't recoup any capital gains. But if the market goes down in that week, I don't lose out on potential income whereas selling out of the money you do. Okay.